I think geopolitics in general are on the radar. If we were talking about Iran, if we were talking about North Korea, so it's
China,
not necessarily,
trade war. Yeah.
Exactly. You were talking about 7-1, people looking at the yuan in the same way. So I think what really has occurred in the market is we had a level of complacency that was kind of developing. We have our own kind of proprietary metric for watching how investors are positioned, not how they feel. Our panic euphoria model.
I love it.
It was edging to, 44 would get you to euphoria levels. You were at 42 on Friday. And it's been edging up over the last.
So I want to make
weeks.
this is very cool, you guys. It's called the Panic Euphoria Index, and 44 would be just extreme joy. I mean, just dancing through the fields.
Well, it's more about what the market reaction would be. So when you get into euphoria level, you have a 70% chance of losing money. Now, to give you context, that's 3 times the random probability of losing money. So if you're in panic levels,
we're too complacent. We're too happy.
We're too the
positioning is too happy.
So I was talking to one client, for example, last week, who made a comment to me. He says, "Well, we're worried about X, Y, and Z." And I said, "Well, and you're saying you're not worried because you're worried. I mean, do you understand the kind of double negative?" And the reasons for that. Okay, so why would people feel relatively complacent, right? And there are probably 3 key reasons. 1, the U.S. economy is in pretty decent shape. 2, earnings have been outstanding if we see the second quarter results. And 3, powerful buyback activity. So there's kind of this almost put in the market. If it goes down, we'll see the buybacks kick up, and that'll support me.
Do you think that will support if we start to see some kind of a China/Turkey/whatever contagion? Can corporate America's big buyback buying programs back us up? It
helps, but you have a $27 trillion market. So it's not going to offset everything. The fundamentals are far more important. Earnings are far more important. And in fact, if you look at the last great year for buybacks was 2007, and that was the top of the market.
We know what happened in 2007.
So just suggesting that you have buybacks and that protects you is the wrong thing. We watch one other thing, which is a little bit more shorter-term indicator, which is the top 50 by market cap in the S&P 500 accounts for about half the market cap of the S&P.
Yeah.
Their intra-stock correlation, how they trade relative to one another, had dropped to about 10%, which means nobody was macro concerned. They were very idiosyncratic. So we can look at indicators to give us a sense, aside from the qualitative feel of talking to investors.